some of the most common investing beliefs deserve a second look. I'm joined by Sam Husco of SGH Wealth Management to break it all down for us. Sam, thanks so much for joining me.
Absolutely, thanks for having me.
I've been looking for this conversation because I get to ask you some harder hitting questions, maybe a little more controversial, if you will.
Okay.
And look, anybody with a pulse can look smart when it comes to new market highs, right? I'm sure you've experienced this, but what trait do you think matters most when the market stops flattering everyone?
Yeah, I mean, if the Isley brothers were economists, they'd be saying the economy's getting a little softer now. And so within that, we can't all rely on Daddy Warsh to, bail us out with another bliss trade every time. And just because there's not fins in the water doesn't mean there aren't sharks. So we can't get soft. Portfolios, how do you know if it's durable or just untested? And that's where I'd say durability, in a downturn especially, durability creates optionality, which creates opportunity. And that's not like a tagline, that's actually how you can add alpha through behavior. Behavior is the true alpha. So I'll give you my 3 rules of managing a bubble. Number 1 is recognition. So don't wait until the documentary comes out. You got to recognize this early, and valuations matter. They're just not going to happen on your timetable that you wanted. So number 2 is resilience. In my opinion, this is not the moment to add leverage. This is not the moment to be overconcentrated. Leverage just turns a mistake into a tragedy. And so that's something that I'd avoid. And then number 3 is have an exit strategy. Don't wait around until the cult starts passing out Kool-Aid. You have to get things earlier. And don't confuse being early with being wrong as well too. It's very hard to be early and then watch things not go the way you wanted to, but nobody remembers who sold out 10% off of the past all-time high. So those would be my ideas on that.
Oh, well, I think that's great advice. And given the data though, why do you think investors spend so much time trying to predict the markets and so little time building a system that they can actually just live with?
Yeah, I mean, it's addictive, right? I mean, I think it's fun to pretend we can all predict things, but that's just not reality. I mean, I would challenge anybody, name me one famous successful investor that made their money off of economic prediction. I'll wait, there's nobody. And so all the GOATs did it off of behavior and adaptability, but people want that easy button. The problem is the world isn't safe. We can all pretend that, reality is safe, but it just isn't. So we have to know that forecasting is just entertainment. And, the other thing is the unique blind spot that smart people have, intelligent people, is ego, okay? And intelligent people also think that they're above ego, and that makes
None
a bigger...
of us are above ego.
Yeah, and then it makes a bigger blind spot. And so within that, when the markets go up, our IQs go down. It's just a very natural thing. So don't predict the future, rehearse for it. And, if there's a 58-year age gap between me and Charlie Munger, the late Charlie Munger, but he is my spirit animal. And what he would tell us today is, I'd rather be approximately right than precisely wrong. And that's really the strategies that we employ too. So
I would have to agree with you there. But what belief then about income investing sounds sophisticated in, say, conference brochures or
Right.
posters or whatever, that falls apart the second real life shows up?
Yeah. I mean, I think we're all seeing a moment where people are having a chase for yield. Chasing yield is dangerous. I mean, it's like a lot of people looking for that miracle diet drug or whatnot, and you can chase it, but it will catch up with you. Anything that is too good to be true probably is borrowing from your future. And so the first one, and this is what I've been quoted in Bloomberg the most, is private credit. And I'm not a fan of anything that's illiquid to that degree. If it's marked to market and you can't get it when you want it, is it really something that's a diversifier and democratization, or is it just maybe dishonest a little bit that it could be something of an innovation as opposed to something that's just going to hurt you? The second one is dividend stocks. I'll channel my inner Chris Farley here and say, do you remember back in the 80s when dividend stocks actually made money? That was awesome. But they haven't. I mean, dividend stocks to me, and both of them are similar, which is kind of an odd thing. Dividend stocks and credit private credit are both in this like hybrid space in between, but they're worse at both. If you want growth, don't bring a minivan to a drag race, okay? Like you're gonna want the muscle car at some point. And if you want safety, don't pretend that a tiger's a vegetarian just because it eats a couple plants. It's gonna hurt you on the downturn, and the crash feels bad, just as bad in both instances. So keep in mind, asset allocation is still the better mousetrap. We wanna turn it into something else, but if you're reaching for yield, why not just get into the stock? You'll get what you're asking for with the stock, but playing that high ground or the middle ground, that's a recipe for disaster when the next downturn occurs. So,
well, you're a great advisor, but I think you'd even be a better author with the one-liners and the analogies you're dropping here. I love the explanation of all this. So I want to just pivot topics a little bit and talk about retirement planning.
Yeah.
Because if you had to kill, for lack of better words, one sacred cow in that space, what dies first?
Yeah. I mean, in our experience, like retirements are more killed silently than dramatically. And what we see as the silent killers usually are overconcentration, sequence risk, but the number one with a bullet right now is poor tax planning. So within that, the current study right now says 70% of Americans don't feel like they have a proper tax strategy in place for their investments.
Bit of a staggering number.
Yeah, and the IRS is undefeated. So it's like if you're going into that fight without a plan, they're gonna win. And so within that, April 15th is not the biggest tax bill that people will spend. It's actually between the ages of 65 and 75 without a proper retirement plan. And whenever I uncover somebody who has like super large RMDs that are getting in their way, all it's exposing is decades of procrastination. They don't know that they're telling me this, but when I see it, it's decades of procrastination. So it's, don't donate to the IRS. They have enough money. It is really frustrating because when you get somebody in the accumulation phase, they spend 30 to 40 years of their life, making sure their fees are super low, grilling me about returns. They're super dialed in clients. Then the minute they retire on their tax planning, they're improvising like it's open mic night. And so, look, you got to stay the focus, but I would say the biggest low-hanging fruit for folks right now is a proper tax planning strategy. So,
hey, we can't escape that three-letter word, right?
Yep.
Sam, it is always a pleasure getting your perspective on
Absolutely.
things happening in our industry. So thank you for sitting down with me.
Yep. Thanks, Shannon.
For Wealth Management, I'm Shannon Rossick.